All right, welcome to lecture 1.2 for BSAD 525. We're going to look at measuring performance today, how to use financial information for strategic purposes in this course. Let me share my screen here. So, as I mentioned in the last lecture, there's this quote attributed to Peter Drucker. I've said apocryphally. It's one of those things that people say he said, but we don't actually have any evidence that he wrote it down anywhere. But it's a good saying that if you can't measure it, you can't manage it. And you might remember from your accounting class that we have different uses of financial information. Investors, the government wants to measure it to assess taxes. For our purpose, we're interested in it as CEOs trying to evaluate performance of our firm and other firms. So we're going to look at how we use this accounting information that you guys are used to having and have learned about in your accounting class. How do we use it to analyze a firm's performance? First thing you got to do, of course, is actually find the financial information. There's lots of different places you can get it. Yahoo Finance, Morningstar, Google Finance. I really used to like Morningstar at my last place, especially if you don't have access to what we're going to use, which is called S&P Capital IQ. It's handy to have something that lets you export it to Excel. The firm's own investor relations website will have their 10Ks where you can get financial information. The Security and Exchange Commission EDGAR database is where every firm's 10K is uploaded to, every publicly traded firm. Now, we are going to, as I said, use S&P Capital IQ, which is a great resource that we pay a lot of money for here at Nichols, and it's a great opportunity for you to use an industry standard tool for financial analysis. One other kind to be aware of, so that's a paid database. Another example of a paid database would be Bloomberg or a Bloomberg terminal. I'll show you a picture of one later. We don't have access to those here. I had one at my old place at University of Calgary. They're like a $20,000 a year subscription or something crazy. So obviously, and beyond what we need, but that's what stock traders use to make trades as a Bloomberg terminal. Financial websites, Google Finance, etc., Yahoo Finance, all great. But again, we're going to be using S&P Capital IQ. So I'm going to fast forward past these slides here because it tells you how to use websites that we're actually not going to use. Quick note on the Bloomberg terminal. It is the product of Bloomberg. You might have heard of Bloomberg News or Michael Bloomberg. He was the Democrat candidate for presidential candidate in 2020. He never became the actual candidate. That was Joe Biden, obviously. And he was a former mayor of New York after Rudy Giuliani. But he made his money selling these things, these Bloomberg terminals. And you might have seen pictures of it. Whenever you think of a stock trader, I think this is the picture you get in your mind of all these screens. This colorful keyboard is the Bloomberg terminal, and it's a paid tool for industry traders, but they're expensive. Yeah, $30,000 per year per user. That's probably gone up in a couple of years since I made these slides even. So we use S&P Capital IQ. Keynote here, you need to make sure that you can log in and use S&P Capital IQ. That's where you're going to be getting your information. If you have any problems doing that, you need to get in touch with their help function and call them up and get online. If you've been doing this for a few years, your username might have expired. You'll need them to renew it. If you lose your password, whatever, you just need to be able to get on. Don't be that person in your group who says, I don't have access, I can't do the work. Group members, don't accept that from any of your group members. If for whatever reason you call their support line, which is usually very good, I have to use it fairly often for my own research, and it doesn't work or it's taking too long, only then after you've called them, send me an email and I'll do what I can to get you going, but you need to be on S&P Capital IQ, and as I mentioned before, have a Wall Street Journal subscription to do this course. It's not optional. So how do you use it? Well, first thing you do, search for your company in this handy title bar up here. You'll find your company. You can look it up by stock ticker. My favorite stock ticker name is HOG for Harley Davidson. It'll bring you to a dashboard for that. The quick report's interesting. It'll have a little business description and some key metrics on here, maybe the stock price, that sort of thing. And across the top here, you can download the 10K, a Capital IQ report, which gives you their own analyst's view on the firm, and other info. We'll go into more along what's on the sidebar here in a minute. You can customize all of this. I just use the default, but if you want to, you can customize really every axis of your Capital IQ dashboard. These are the reports we're going to be looking at on the left side here, mostly in this course. The financials and valuations are going to be key. So we'll take a look at Harley Davidson's statements, recent statements here ending 2023, so not as recent as they were when I made these slides. We can look at longer or shorter periods by sliding this bar here and get more dates. Be aware of what you're looking at. Make sure you know whether you're looking at annual numbers or quarterly numbers. Obviously, quarterly numbers are going to be smaller in terms of things like revenue, profit, etc., because you're looking at a smaller piece of time. So your income statement accruals are shorter. We're going to generally use annual here, but you may also change this to quarters. Be aware of what your presentation view is. I prefer latest on the left. That's just what you get used to looking in most financial industries. However, when we go to graphing this info, of course, you're going to want to present it left to right. So you can just change that here and show your financial information left to right in order to export it to Excel and make your graphs. Other thing to be aware of here is your template. There's a standard format option here that presents everything in S&P Capital IQ's standard format. Every company's going to present their expenses and their income statements and their financial statements slightly differently. If you do it standardized, it just sort of filters everything into standard categories that they'll use here. Obviously, if you're looking at Walmart, they're not going to have a category called motorcycles and related products. So this is as presented. That means it's as presented by the firm, whoever is produced the 10K or the financial info this came from. Standard is great, as I said, for comparing to other firms, but when you start to really want to analyze your firm, you're going to want to look as presented so you can actually see what these items are. You don't just want generic SG&A expenses, you want to know what these expenses actually are, and that's how you see them, is by changing this template. So what do you focus on? Different types of info we have. We have the financial statements that are produced by the firm or their accountants and then audited. We have market information, what the markets tell us about their securities, what's the stock price, how's that moving, who owns the firm, that sort of thing. And then we have news information, news items, either from the firm itself and their investor relations news releases, or from third parties like Wall Street Journal and other news sources that analyze the firm's performance. And we want all three of these. We want to know what they're saying about themselves. We want to know just current market data about how they're trading and what their stocks are at. But we also want a critical view from a third party that says how they're doing and maybe why that is. We don't just want to take their word for what they tell us about their performance. We're going to start here with the financial statements. So the first statement that we always look at is the income statement. As a banker, the first thing I always looked at was revenues. It gives us an idea of the size of the firm. How much money are they generating? Of course, you'll want to figure out what denomination you're looking at here. This is Harley Davidson. They didn't make $4,000 of revenues or 4,527. These are in millions. So they made $4.6 billion roughly in revenues. Over here we have 5.3 billion roughly in total revenues. That tells us how big we are. When we start talking about our size relative to competitors, we're talking about revenues, not employees, not anything else, revenues. How many customer dollars are coming into the company? That's our main source of size. The next thing I would often look for would be, okay, how much of these revenues, these total revenues, made it to profit? How much profit did they have to distribute to shareholders or to reinvest in the company or to pay debts? It's called the bottom line because it comes at the bottom of the sheet. Now, of course, there's other stuff that shows up under here in your financial statements on S&P, but traditionally this is called the bottom line, and it tells us, all right, how much net profit did we make? Not the same as cash. I'll tell you later what the difference is, and you will hopefully be familiar with that from producing cash flow statements for your firms. This is based on accrual accounting, not cash accounting. FYI, there's a lot of information here that we just won't look at. Most of it's below what I've highlighted here in this slide, but don't get scared. There's lots of stuff here. We're going to focus on what matters for our purposes, especially in the broader software in S&P Capital IQ. There's lots of stuff mainly investor info that we just don't really cover in this course because we're not looking at the firm as an investment. We're looking to see how it's performing. The stock price can go up and down for reasons that have nothing to do with firm performance. If the economic environment changes, if interest rates go up, if inflation's going up, that might have an impact on stock prices that has nothing to do with firm performance. So we're primarily interested in non-investor metrics, non-stock price metrics, although I do want you to look at them and just see what the market thinks. That's what the stock price tells us from our perspective as managers is how do investors think we're doing always compared to something else. Going from top to bottom of the income statement, after we've looked at the revenues, we want to look at gross profit. What this tells us basically is how much they can mark up over their cost of goods sold. All sorts of things go into cost of goods sold. The labor that's attributed to the product and making the product or service, the inventory, the materials. Once we've done that, those basic costs of making and selling the product, or rather just making the product, how much can we mark it up above that? These numbers are going to get smaller, obviously, as we go down because we're always subtracting different expenses. Once we've looked at gross profit, which tells us how much we are marking things up by, right? Whatever our revenues was versus COGS is how much we marked it up. Then we can start going down and looking, okay, well, what were our operating expenses? How much did the operations of the business detract from this gross profit margin here? This is our operating expenses are a great measure of our efficiency in other areas besides the production of the good or service, which was in the COGS. This tells us our operation efficiency. Next thing is EBIT. Down here, EBITDA, sometimes used, or EBITDA. These all stand for some version of earnings before interest, tax, and depreciation. Oftentimes, bankers and investors and even people in the company will use this as a proxy for cash flows. It's not the same as cash, but we're adding back things that aren't cash. Depreciation and amortization aren't paid with cash. They're an accrual. So if we want to know how much cash we have roughly, we just add those back in because they weren't actually paid for in cash. Somebody made an investment in the past and is depreciating it. We might prefer EBIT. In EBIT, we don't add back depreciation and amortization. Sometimes when I was looking at a capital intensive industry, I'd use EBIT instead of EBITDA because the fact was if it's capital intensive, they're investing regularly, and that depreciation and amortization gives us an idea of how much they're spending every year on their assets. So you won't need necessarily to use either of these too much, but it's worth knowing about because you'll often, even when you sell or people are talking about how much a firm is worth, they'll use what's called an EBITDA multiplier. How many times EBITDA is the firm's market value? What multiple of EBITDA are they trading at? And the reason EBITDA gets used again is because it's a quick and dirty way to estimate cash flows if we only had the income statement. Now, of course, we have a cash flow statement, so we'll move to that in a second because it's It's the straight from the horse's mouth. Tell me where the money's going. That's my favorite financial statement for a lot of purposes. Next statement is the balance sheet. That tells us more about how things are being financed. If you remember your accounting balance sheet equation, assets are equal to liabilities and shareholder equity. So for every dollar of assets, that was financed either with debt or with equity. Tells us how leveraged or indebted the firm is. When I was a banker, I tended to look at a few things first. How much cash does the firm have on hand? We'll talk about why later. Are they running do they have a cash crunch? How much cash should we have on hand? Well, it depends, and we'll talk about that in a minute. How asset intensive or how capital intensive is this company? I was interested in this as a banker because I wanted to know about assets that I could take security over, hard assets that hopefully maintain value and could be sold if they defaulted on their debt, which leads us to the next category here, which is their debt. What proportion of the assets of the company are financed by debt versus owned by the company's shareholders? If it's all financed by debt, that could be a problem, especially when we start to get into cash flows and interest payments. Something we'll talk about in a minute. Then my favorite financial statement, the statement of cash flows. If you've seen the movie Jerry Maguire, show me the money is the saying that Cuba Gooding Jr. famously says there. And it just tells you straight up how much cash came into the company and what did they spend it on and how much was left over. So this tells you right here how much cash actually came into the company. Sometimes this will be very different. I've shown the net income here. And if you look at that, the cash actually coming to the company isn't the same. Sometimes it's more, sometimes it's less. If the company is declaring a lot of net income but still has some cash flow problems, it's because of what they're doing in the accounting process, and they might have a problem that you wouldn't realize just by looking at the income statement. Likewise, they might be doing better than you might see just from looking at the income statement. Famously, when I was banking farmers, they would always have a net income loss because they had all sorts of allowances so that they wouldn't have to pay taxes. Everybody wants to state their net income just like you do on your tax statement as low as possible because you're taxed based on your net income, not your cash. But cash says what actually came in. Then you can see here what they used on the cash. How much did they spend on investing in different assets, capital expenditure? How much went into operations? How much did they use on paying debt? Did they do any stock buybacks or pay any dividends with that cash? All really useful. And as you can see here, the net change in cash for, I think this is Harley Davidson here still, in 2019, they actually had a net outflow of cash of 354 million, even though their net income was 423 million. So if you're just looking at this number, this 423 million on the income statement, you'd say, oh, they had a lot of cash come in. Or if you're just looking at EBITDA, but if you look at the actual cash flow statement, they had a net loss of cash that year, which is significant and a pretty different story. So I say here, it can reveal fishy things you didn't see on the income statement, write-downs or other things that they sort of jiggered around in the accounting side on their income statement. You can't do that on the cash flow statement. It just tells you exactly how much cash came in, how much cash went out, and how much they were left with at the end. Once you've looked at the financial statements and maybe hopefully come up with some questions, which you should always be doing, what happened here, what happened in this year? Well, how do we get more information? For that, we go to the 10K. Look at the accounting policies, look at the management discussion and analysis, figure out what were they borrowing money for if they took on debt. Oftentimes you'll see a huge spike in debt over time. Oftentimes that's the result of a merger and acquisition that you should find out more about, or maybe a huge capital expenditure that tells you something about their strategy. So always look at their management discussion and analysis and the comments on the financial statement. How much of their operating line are they using? Do they have a line of credit with the bank? Is it maxed out? That could be a problem. Are they not using any of it? That might be really useful. It means they have a bit of margin that they could use if they needed to make some investments or if there was a down cycle. Know your firm and know their financial policies and what they have available to them. This is a very important slide here and a very important point I want to make. You might look and say, hey, this company has 30% gross profit, Harley-Davidson. That's really good. Well, is it or isn't it, right? It depends. It depends on what you're comparing it to. Financial information is only useful, generally speaking, when you're comparing it to something. Who do you compare it to? Well, you can compare it to the company's own performance over time. Are they improving in different areas or suffering a decline? Likewise, you'd want to compare it to their competitors. I might think I'm a really good golfer, but compared to who? If I compare it to my kids, maybe I am. If I compare it to the best professor at Nichols, maybe not as good. If I compare it to the PGA, I'm actually probably a pretty terrible golfer. So we need to think about who it is that we're competing with, what our industry average is. That's also helpful, but usually if you're studying a big firm that investors expect a lot from, even the industry average might be understating the performance you need to satisfy your investors. So usually it's your competitors, your most similar competitors, the people you're competing for customer dollars that you want to compare yourself to. And start looking at these numbers and saying, how do we compare? Are we better? Are we worse? Do we have a different capital structure? That's fine. It's just different. All great questions. A great way to do this, and really the way you want to start doing this, is by using these common size financial statements. I talked about how there's as presented, which is how the firm states them. There's standard, and then there's common size, which is their S&P Capital's standardized way of presenting it, but as ratios. Everything here on this income statement is presented as a proportion or percentage of revenues. Now we can start comparing things. How do our cost of goods sold compare to our competitors? How is our gross profit compared to our competitors? How much can we mark our stuff up by versus our competitors? Maybe we sell a differentiated product like a Harley-Davidson and we can mark it up quite a bit over our COGS because customers are willing to pay for it. So it's extremely useful, and you really can't make comparisons aside from just the size of the revenues, which you might want to compare just to say, are we bigger than them or smaller? But if we want to compare different aspects of this financial statements, we really need to turn it into a ratio. That's why we use ratios for analysis. Here's the common size balance sheet. You can do this with all the financial statements, present them as common size. Now we're looking at everything as a percentage of assets. How much are our liabilities as a percentage of assets? How much is property, plant, and equipment as a percentage of assets? In the case of Harley-Davidson, it's surprisingly small. Most of their assets are tied up in inventory and leases, right? Harley-Davidson's financing assets, money that they're expecting to collect from customers who bought their Harleys through financing them through Harley is their biggest asset. Future payments. What size is cash as a percentage of receivables? All these things are interesting to tell us what are these assets financed by as different percentages. Little pop quiz here. What happens if a firm's liabilities are greater than its total assets? Well, if we think about this equation, if this number is bigger than assets, if our liabilities are greater than our assets, we're going to have negative shareholder equity. In almost every situation, that is bad. It means your firm's in trouble. With a couple exceptions, companies that are very cash flow positive will allow themselves to finance everything with debt, including operations, and just give all the profits back to the shareholders. In a minute here, later on, we'll talk about the DuPont equation and what's called the equity multiplier. If you can get away with financing everything with liabilities, in theory, you're giving an infinite return to your shareholders because there's no shareholder equity. You make an investment of $1, you borrow 9, and that return gets amplified by the debt. You didn't have to use your own money to get the return. You borrowed money and got a return without having to put your own skin in the game. So you may see, I don't think I've seen any companies yet that would have this, companies that have negative shareholder equity because their liabilities are bigger than their assets. So watch out for that. Usually a bad thing, but in the rare case of very cash flow positive companies, it's actually a sign of just how much cash they make. The only time I've seen this in a good scenario in this class was a group that was looking at a tobacco company. I think it was Philip Morris Tobacco. they had negative shareholder equity because they turned out so much cash that they didn't have to really worry about the risks of cash flow to cover interest. Their bond holders and debt holders were fine with them being really leveraged. I used to see this with dentists as well. When I was a banker, we would lend dentists as much money as they want. And when they were starting out, they had more liabilities than equity. If you're a student with student loans, that's probably you. You have more liabilities than equity. So where do we get information and how do we choose our competitors? Well, there is a tool for this. And why do we do it? Well, if we define our industry incorrectly, we're going to be comparing ourselves to the wrong thing. All your external analysis and your financial analysis depends on who you're comparing yourself to in the case of finances, or what your industry is when you're doing an industry analysis. So you need to define your industry carefully. And sometimes, with you guys, you're choosing firms with multiple segments. You may need to choose a segment when you do your Porter's Five Forces analysis. If you're looking at Apple, for example, well, the cell phone or the mobile phone industry is a different industry than music streaming. If you were looking at the music streaming industry, you'd want to compare Apple Music to Spotify, YouTube Music. If you were looking at Apple TV, you'd want to compare it to Netflix and the streaming industry for video. If you're comparing if you're looking at iPhones, you'd want to compare it to the smartphone industry. So define your industry appropriately, and you may have to narrow your definition to a reporting segment. It may not be clear cut. Maybe you'll have to look at revenues and say, okay, where are we generating the majority of our revenues? Which segment is generating the majority of our revenues, or which product? Then we can compare. In the case of Ford, for example, by far their biggest seller is trucks and SUVs. That might be the sub-segment of motor vehicles that you want to compare them to, and other companies for whom that's also their main product. This competitors tab, I show it to you with a warning that it may not provide any useful competitors. We'll look at that in a second. So if you look at this competitors tab, and as you can see here, it's a bit fuzzy, unfortunately. I'll post the slides and you can zoom in. But we have some companies here that do make sense. KTM makes motorcycles. Ducati makes motorcycles. Some of these this is BMW, this big German word. Some of these make a little less sense. Ferrari, right? Are we really competing for customer dollars with Ferrari? I don't know. $100,000 car with a $20,000 bike. I think here we have Louis Vuitton Moet Hennessy, a luxury brand that makes handbags, champagne, cognac. Is that a good competitor? I would suggest to you that it's not. Now, the next question you ask is, well, why is it listed? Well, basically, this tells us the source. And why do we have Louis Vuitton Moet Hennessy here? Well, apparently somebody looked at Ferrari's 20F, which I think is the European version of a 10K, and Ferrari listed Louis Vuitton and Harley as competitors. And so this ended up as one of Harley's competitors. So feel free to look here for ideas, but do not try and tell me we put this person as a key competitor or chose them as a main competitor because it was on the list on S&P Capital IQ. That is not good enough. I am going to probe your choice of competitors beyond this. I want you to be thinking of products and who are we competing with for customer dollars. I've said this is your best friend for analysis. Again, maybe I should put a warning here. It's only as good as the competitors that it lists, but it does give you some quick ratios compared to your other competitors. And you can choose which ratios you have here. LTM means last 12 months. So what's our last 12 months gross margin? Here's Harley's versus Polaris. Polaris is probably a very good competitor. They make Indian motorcycles. They're an American company. And here you can see, okay, Harley's gross margin is 30% versus Polaris is 22%. Of course, there's a lot of other stuff mixed in this with Polaris besides motorcycles, right? Side-by-sides, quad bikes, those kind of things. So use this again with some discretion. CarMax, I believe, is a secondhand car dealership. Probably not the best comparison with Harley Davidson. Piaggio sells scooters. Maybe not the best, but it's at least in the right ballpark. But you're going to want to be very careful which you choose. This is kind of a broad picture very general, zoomed out level to look at. All right, I'm going to go to our next set of slides here, part 2, as I call it. So now we're again looking at specific ratios now, specific ratios and measures of profitability, liquidity, asset utilization. I've got the category here. So our first measure of profitability is that gross profit. How much can we mark up over our cost of goods sold? Revenue minus whatever we charge the customer, whatever they paid us, minus whatever we had to pay to produce the goods is going to give us our gross profit. The more we can charge them in terms of price and the volume sold, the more we can mark it up over our COGS. We want to charge as much as we can to maximize gross profit. If we raise that price too high, we'll sell fewer. If we put it too low, we won't have much profit margin. There's an optimal point here. Most of these firms are figuring it out by trial and error. What goes into COGS? Well, labor goes into it. That's why laborers are paid hourly, is so that their labor and the cost, their hourly wage, can be allocated to the products that are made, the materials used to make it, the manufacturing overhead directly associated with making that product, factory time, maintenance of the factory, electricity that's involved. All these things are allocated to COGS because they're deemed to have been direct expenses for making that product. Inventory that we sell, right? Once we've made the motorcycle using the materials and the labor, it becomes inventory. When we finally sell that inventory, it turns into revenue. So it tells us how much the firm's making directly from the sales of its goods and services. But we can't, it's hard to compare that with other firms of different sizes. So we turn it into a ratio called gross profit margin, which is simply gross profit as a percentage of revenues. Now we can see, okay, is there anything we can be doing to lower our COGS with respect to our competitors? And how much are we able to mark up our product in compared to our competitors? Maybe we're selling our products at roughly the same price. You guys go and do some research and find out, hey, a Harley Davidson Ultra Glide 2026 costs the same as a Ducati Cruiser of some sort, but their COGS are much less than us. That must mean they're more efficient in their production, or else they're getting their supplies more and materials more cheaply. Something's going on there. So you need to figure out what the prices are and then compare the COGS costs. Maybe the COGS, maybe gross profit margin's higher because our price is higher, or maybe it's higher because our costs are lower, or vice versa. Maybe our gross margin is smaller because we can't charge as much of a markup, or because our costs of goods are higher. Some industries are characterized by very thin margins. Grocery stores have very thin margins. If your firm is competing on a cost leadership strategy, like Walmart or a gas station, right? A gas station can't mark up their price of their gas or nobody will buy it. Nobody cares what brand their gas is. So they're going to have generally thin gross margins. By contrast, a firm that's competing based on differentiation and creating a higher willingness to pay will have a higher gross margin. That's where you'll see it. By definition, luxury goods have a high gross margin. I've got Louis Vuitton Moet Hennessy's gross margin here, 68%. They make a t-shirt in Bangladesh or wherever, put a Louis Vuitton logo on it or a handbag, and they charge an extra big premium. This is a huge gross margin compared to, say, Ford, who's competing on price, which only has an 8% gross margin. They're not able to mark up their vehicles very much because they're competing with GM and Toyota in a very competitive market. Customers just want an F-150 or some kind of truck that has a certain size, certain engine size, certain feature set, and really they're not willing to pay much extra for the Ford name. Another profitability measure moving down the income statement is operating profit. Once we've subtracted our cost of goods sold from our revenue, next we have a bunch of different operating expenses. I've got them listed in standardized here. Once you've done the ratios, though, go and see what's in there in the as presented template. Our operating expenses here tells us basically, okay, how efficient are we in managing our operational costs compared to our competitors? Are our operating costs higher or lower? Louis Vuitton Moet Hennessy has pretty high operating costs. They're probably spending a lot on marketing, on branding, on creating new lines of clothing, whereas Ford's operating costs are actually quite small, 5.6%. Now, you wouldn't compare these two if Ford was your company or Louis Vuitton, but this shows us the difference between a differentiated luxury company and a company competing on price. Ford doesn't have 43% left to use on operating expenses because they only have 8% gross margin, right? Those numbers can only get smaller as you go down the income statement. Ford has to be much more efficient with its operating expenses if they're going to have anything left for operating income. Operating income is often the most useful form of profit of net. It's often more useful than net profit or net income because net income includes other stuff from operations. If they sold a piece of property or some assets and made a gain on that, that'll show there. If they lost something on an investment, that'll show there, but it's not from the operations of the firm. It's other stuff, taxes, etc. So operating income is often the most useful, is more useful rather than net profit. Operating margin is what we'd want to compare with our competitors because, net income margin, maybe we sold something and made a bunch of money or lost some money on the sale. That's not really reflective of year-to-year operations. Next one, net income. That's our bottom line. It is important because it tells us what's available to distribute to shareholders and to reinvest in the firm. So it tells us something about what our likely cash position is, tells us what we're going to get taxed on. It's usually the most important piece of information on an earnings call because investors want to know how much money is available for shareholders. But as I said, operating income is more useful for performance. Little side note here, some companies never pay any dividends. Why is that okay? Well, if they're a growing company, they're going to be reinvesting money in the company, not paying it back to shareholders. Some professors, maybe your finance professor, if you had John LaJohnny, would say that firms should never pay a dividend because it's like signaling that you're out of ideas and you don't know what to do with your investors' money. I think that's a fair assessment. However, there are industries where it's just expected that you pay a dividend. What we used to call widows and orphans stocks. Some investors like to put their money in stocks that pay a dividend and just live off the dividends rather than capital gains. Also, if the tax regime changes and they start taxing capital gains more than dividends, then firms start to pay dividends instead of just reinvesting for capital gains because of the tax regime. So it's just something to be aware of, but oftentimes many firms won't pay a dividend. It's more favorable. Their investors just want the capital gains from the increased stock price, so they reinvest it, especially if they're growing. A growing firm should almost never be paying dividends, especially if it's a startup. So net income margin is just the ratio version of net income as a percentage of revenues. Here we have Ford Motor Company. They have pretty slim net income margin or even negative in some years versus Ferrari, which has a roaring, pun intended, 21.8% net income, much more profitable. Of course, Ferrari's selling a luxury good at a smaller scale. And so they're able to keep a lot more of those revenues because they're marking it up so much. People are paying so much for a Ferrari. But you wouldn't compare these two companies. You wouldn't compare Ferrari with Ford because Ferrari's not competing with Ford for customer dollars. Maybe on a select few, Ford Le Mans, ultra expensive, high-end vehicle. But in terms of the size of their operations, the luxury vehicle segment is going to be very, very small for Ford, whereas if Ferrari, it's their main line of business, Ford's main line of business or largest revenue generator is those trucks and SUVs. So you wouldn't compare these two. I'm just comparing them to show you how different companies and different firms, you can get an idea even of whether you're comparing the right firms based on these numbers and gross margin especially. Let's talk about liquidity measures now. So working capital is one that gets thrown around there a lot. It is not terribly useful for comparing with other firms, but it's like a pulse or blood pressure. It can tell you if there's something wrong that might be a problem in the near future. the formula for working capital is current assets minus current liabilities. And basically it says, do we have enough current assets, right? Current assets are assets that we expect to turn to cash in the next year. And current liabilities are liabilities that are going to be due in the next year. If our current assets are less than our current liabilities, we have a problem. We don't have enough assets that we expect to turn into cash in time to pay these liabilities, which will have to be paid in cash. I've got a question here. What's Ford's working capital for the most recent quarter? We would do this in class if we were together. You don't have to look it up. It's a simple formula. However, a note on this, know your firm's cash cycle. Or its operating cycle. How quickly does something go from an order, your firm makes an order or a customer makes an order, to you producing the good, to you getting account receivable from your customer, to them paying the receivable. Some companies actually have negative cash cycles, which is actually good. A negative cash cycle means that it's measured in days, right? A cash cycle is okay from getting our inventory, from cash going out, basically as a firm for inventory or whatever. How long till we get cash back in from selling the product and collecting the receivables? Well, if that might be 90 days, 6 months, if you have a long cash cycle, even longer. Let's say you're a shipbuilder, you have to buy stuff and build it and pay workers for years before you actually get the cash for the sale. Somebody like, say, Dell, or any company that takes orders in advance, they have a negative operating cycle. They get the cash before they spend any of it. If you're doing for-order computers, you make the customer pay up front. They give you $1,000. Only then do you order the parts. You already have the cash from the customer. You order the parts. You pay someone to put it together. Then you send it to the customer. You have the cash before any has to go out. You have a negative cash cycle. So something to think about. So it might be okay to have a negative working capital if you have a negative cash cycle. If you're getting paid in advance, you don't really have to worry about it. But for most companies, you want this to be positive. This is the ratio version of working capital. So instead of subtracting current liabilities from current assets, we put them as a ratio over each other. If we want current assets to be greater than current liabilities, that means we want this ratio to be greater than 1. Now, there's a better version of the current ratio, which is called the quick ratio. With the quick ratio, which is more often used, sometimes it's called the acid test ratio, we take the inventory out of the current assets. Why do we do that? Well, inventory is fuzzy. A lot of fudging happens with inventory and accounting. The firm says their inventory is worth this much, maybe what the book value, but maybe the inventory, if it's Microsoft, is a bunch of Xbox 360s. If they're recorded at book value of $600, actually, these can only be sold for maybe $100. And we just say, you know what? We don't know what's in that inventory. We don't know how quickly it converts to cash. We're going to get rid of that. And really, then all we have is things that are cash or cash equivalents, like treasury bills and receivables. So this is a more conservative, not in the political sense, but in the risk sense, a more conservative measure of liquidity. Okay, we have these receivables, we have this cash. How much of our current liabilities are covered by receivables and cash, things that are more likely to turn to cash quickly? Cash is, of course, 100% liquid, because liquidity is, well, how much time will it take to turn into cash? And cash is already cash. So it's the most liquid asset. Little side note here, just maybe explain something that might already be confusing you. Why do we talk about, when we're talking about assets and liabilities, why do we say liquidity or solvency? And the metaphor here is that cash is like a liquid that you can, that you want to dissolve your liabilities into. If you remember, say, chemistry, or you've ever had a cup of coffee and put too much sugar in it, if we don't have enough liquid or cash, the liabilities, which we might say are the sugar in this metaphor, it's not going to dissolve and we're insolvent. If we have more debts or more sugar than we have cash, which is our coffee, it's going to be insolvent and we're going to have a problem. Some assets are more liquid than others. Low risk financial instruments like treasury bills, those are as good as cash for most purposes. Some assets have very low liquidity, really specialized equipment. You might not be able to sell it quickly for the amount that you paid for it or that you have it on your book set. If it's a piece of equipment that really is only specific to your firm, that's not going to be a very liquid asset. If you want to sell your Pizza Hut equipment, maybe your only market is other Pizza Hut franchises, and they may or may not be buying your assets. If the franchise is shrinking, maybe nobody wants Pizza Hut equipment. I've got this example here. Which do you think is more liquid in Thibodaux, a $20 million mansion or a $200,000 starter home? And the answer, of course, is a $200,000 starter home, because this is what more people are looking for, this kind of house, than they are for a $20 million mansion. If you've seen some of these mansions for sale around Thibodaux, they'll often sit on the market for years. They'll probably end up selling at quite a steep discount to what's being asked, because there just aren't that many buyers. And if there aren't many buyers, there isn't an efficient market, so the asset will be not liquid. Contrast that with treasury bills. There's always a market for treasury bills where they're traded every day. There's always buyers and sellers. They're a very liquid asset. So that's what this is all about. When we say that a company's insolvent, it means they can't pay their liabilities, and that usually means there's going to be some bankruptcy proceedings happening in the near future. All right, let's look at short-term asset utilization now. This tells us how efficiently we're using our short-term assets on that balance sheet. Inventory turnover is measured as COGS over the average inventory. Now, the problem here is that if we're looking at a snapshot like our annual financial statements, we're not getting the average inventory. We're seeing what inventory was at the end of a reporting period. This number is often going to be bigger than it should be. Or not accurate, because it'll be bigger than it is most of the year, because most firms do their financial year end when their inventory is as low as possible. Why do they do that? So they don't have to count too much inventory. Most retail companies that sell to consumers will have a year end maybe on January 31st after the Christmas rush, when they don't have much inventory on hand that they'll have to count, which is costly, right? You have to pay an accountant to audit your inventory. The less inventory at year end, the better. So this will be smaller than it should be, and the ratio will be larger than it should be. But usually this is the best we have to go on. For this ratio, I would recommend using quarterly average over a year. That'll give you a chance to see if there's any points of the year where inventory was quite high versus quite low, and that average of all the 4 quarters will give you a better idea of their inventory turnover. Similar here with receivables turnover. This tells us how quickly we collect on our receivables. You might remember that. As a proportion of sales, how much of that is accounts receivable? Now, the problem here is that we really want access to net credit sales. If we try to run this just as sales over receivables for Walmart, it's not really meaningful, because at Walmart, you probably don't have an account with Walmart where you say, okay, I just bought, a bag of porridge and some toilet paper, and the payment terms are net 30. No, Walmart doesn't give you 30 days to pay. You pay in cash. So depending on your industry, this probably isn't interesting. For a company like Harley Davidson, this would be very interesting, because a lot of their sales, maybe even most of their sales, are on credit. But you really need to be able to get at how much of these sales were credit sales versus cash sales, because if it's a cash sale, you don't have any accounts receivable for that. And again, you have the same issue here with wanting to average it out. There might be seasonal spikes and dips in the accounts receivable. So if you'd want to average that out over the 4 quarters, again, you can get that information from S&P. One way that we can make this information more tangible and more useful is to take this number and divide the number of days in a year into that number. What does that tell us? Well, then it tells us inventory days, or on average, how many days does our inventory sit with us? Likewise with receivables, if we put this number here into the denominator and then divide the number of days of a year into that, it tells us on average how quickly we collect our receivables. If we have payment terms of net 30, that is, we tell our clients you have to pay us in 30 days, this number should be 30 days or less. If we have payment terms of net 30 and this number is something like 90 days, 100 days, that could be a pretty good indicator of a problem collecting receivables that you might want to analyze, especially if your firm is extending credit and doing sales on credit. It's a business to business rather than a business to customer, or it's a product you sell to customers that they often get financing for and pay in financing, pay by a financing arrangement. If you add these two together and also add your own payment terms, you get your cash cycle. When does the cash go out? This tells us how long the cash, once we've bought our inventory, how long the cash is going to sit there. And then this tells us how long after we sell the inventory, after it's done sitting here, does it take for us to actually collect the cash. So these numbers are also useful for calculating your cash cycle or your operating cycle. Let's look at some measures of overall performance now. Return on assets and return on equity. These are a mix of income statement and balance sheet numbers. Return on assets is just net income divided by our total assets. And it tells us how efficiently is our firm in utilizing all of our assets to generate net income. That's a great one to compare with other firms. We have all these assets on the balance sheet. How much net income are we generating for each dollar of assets? We also have return on equity. That tells us per dollar of equity investment, how much net income are we generating? Now, I don't like this as a measure of performance. As a measure for shareholders and investors, it's great because it says how much net income do we get per dollar invested. But the thing is, capital structure is discretionary. The finance officer, the CFO, will have a target capital structure. When we look at debt to assets or debt to equity, you may see that over 10 years, that ratio hardly moves because they're deliberately targeting a certain capital structure, say 80% debt to assets or something like that. And it's just always the same. Another firm says, well, we want to have a 60% debt to assets. Doesn't really tell you anything about performance. So this number is dependent on a decision that's not strategic and not related to performance, namely the capital structure of the firm. We just want to know, and this is much better because assets is equity plus debt. So this is a better way. We can compare this with other firms that have different capital structures. So I'll want you to mostly focus on this, except when we do our DuPont analysis, which we'll talk about in a minute. Let's move on to leverage now. So leverage, we'll talk about why it's called leverage in a second, but is really about how much debt are we carrying? How much of our assets are financed by debt? They'll be the same result no matter what. If your debt to assets is higher, your debt to equity will also be higher because equity is just assets minus liabilities. So I don't really care which of these you use. They'll tell you the same story. Debt to equity will probably be higher because this includes liabilities in the denominator. So this will always be bigger than this. Unless it's 100% equity, then these will be the same because assets will be equal to equity. So use whichever of these you want. I don't really care. I like to think about this one more just because I conceptually, I find it easier to think of, okay, what percentage of our total assets are financed with debt? This one I have to then think of the capital structure before I figure what this should be. So again, and this is easier to compare with other firms as well, but you'll get the same answer either way. For example, if our debt to assets ratio is 0.6, it means 60% of our assets are financed by debt. I've said here what percentage are then financed by equity. Well, it would be 1 minus 0.6 or 100% minus 60%, it would be 40%. So why is it called leverage? Well, it's called leverage because if you think of it like a lever, it amplifies whatever's happening at the short end of the lever gets amplified at the long end of the lever. So I've got an example here. Let's say that we had a person who invested $10 of their own money in a business. So it's 100% equity, $10 invested, they receive a $1 return. What's their percentage of return? It's going to be a 10% return, right? You invested $10, you got $1 back. Well, forget about interest. You made a $1 return on a $10 investment. That's a 10% return. But let's say now that instead of investing $10 of your own money, you invested $1 of your own money, borrowed $9, forget interest, and you got the same $1 return on that $10, well, actually, you only invested $1 and you made a $1 return. The other nine were borrowed. You made a 100% return. So you've levered up that return by borrowing money. That's why it's called leverage. Now you have a 100% return instead of the 10% return you had when you used all equity. But it swings the other way, right? Leverage swings positive income up higher than it would be if it was all equity, but also it swings your losses further. So let's say now that you invested $10 in a business and you lost $1. What is your return? Well, you lost 10%. Now you only have $9. You lost $1 on that investment. But let's say instead of a 10% loss in this first case, now let's say that you invested only $1 and borrowed $9 and you lost $1. Well, you lost 100% of the amount that you invested. You had a negative 100% return. So it swings, it levers that loss as well. That's why it's called leverage. It causes your returns to be amplified up or down. Obviously, if you break even, it's the same either way. But as you get further away, positive or negative, from that initial return, it's going to be amplified. All right, let's talk about this DuPont identity now. First of all, it's not a ratio in itself. You may or may not remember your trigonometry identities. An identity is just another way of expressing the same ratio, right? If you remember your cos ratio, what is that? Adjacent over hypotenuse. You don't need to remember that, but there's other ways you can express that ratio. Likewise, with return on income, that ratio is just net income over shareholder equity, but you can express it as the product of three different ratios. And why do we do this? Well, it can tell us what's actually going on when this number changes, which, especially if we analyze it over time, is really useful. The reason it's called the DuPont identity was because it was a guy, a finance officer at the DuPont Corporation that came up with this. He'd say, okay, return on equity changed. It improved this year, say, but what actually was going on behind those numbers? And he said, well, we can express this differently, right? And I'll show you how we do that here. We have net income here. We have net income here. And then we have shareholder equity here, and shareholder equity here. Oops, down here. So we have these two things, but then we can cancel these other things out. We have total assets here, which we can cancel out with this. We have revenue here, which we can cancel out with this. So that's how the math works. You don't need to remember it. You don't need to, if that didn't help, don't worry about it. All you need to know is that this is another way, these three ratios, multiplying them is another way to get the exact same answer, but now we can look at it differently. First of these ratios is revenue over total assets. That tells us how effectively are we using our total assets to generate revenue. Maybe our ROE went up because we were using our assets more efficiently and generating more revenue. That would be a good thing in terms of improved performance. Our ROE went up because we were increasing our revenues and asset efficiency. Or maybe our profit margin, right? This is just our profit margin ratio. Maybe we were able to charge more, or we had fewer costs. So our profitability improved, and that's what drove an increase in ROE. However, maybe our ROE went up and nothing really happened year to year between these numbers, but actually we just took on more debt. This is a leverage measure. It's kind of presented in a funny way to make this formula work, but actually our total assets over shareholder equity increased because we took on more debt, which made this number smaller. We took on more debt. This number got bigger with that debt. This number stayed the same. And actually our ROE only increased in this case because we took on a bunch of debt. That made this number look better, but we didn't really improve our operations. We didn't use our assets more effectively. We weren't more profitable by minimizing costs. Actually, all we did was borrow money, and that made us look good, and that might only be temporarily. So if we use this DuPont identity to analyze and to break down what changed, we can tell, did ROE improve because of asset utilization, because of profitability, or just because of an equity multiplier? The opposite example would be, let's say that our ROE went down, and actually it wasn't actually because performance decreased, It was just because maybe we paid off some debt, and that made this multiplier smaller. We had less leverage, right? This is our equity multiplier. If this is, if we're entirely financed by equity, then this is going to equal this, and this multiplier is just going to be 1. If we have a bunch of debt, then this number is going to be bigger than 1 and amplify our returns. So this number might have gone down, but actually it was kind of a good thing. We paid off a bunch of debt, so we shouldn't be hitting ourselves on the back or flogging ourselves because this wasn't about performance. It was just that we paid off some debt, and even though ROE went down, it was for a good reason. That's why we use the DuPont identity. It tells us much more and makes this ROE number a bit more useful. Again, as just a single ratio to measure performance, I prefer ROA, but it's good for you guys to understand this and use it, and that's why I ask you to analyze it. It's kind of an industry standard breakdown of a ratio, and it's good for you guys to go into the working world understanding the DuPont identity. Maybe you have a boss that says, hey, our ROE is up, aren't we great? And you say, well, boss, actually, this went down and this went down. Sorry, our asset utilization and our net income actually went down. We just borrowed a bunch of money because we're not doing very good, and that temporarily boosted our ROE. Maybe we need to have a meeting. So that's why we use that. All right, that is the end of this lecture on financial performance. Looking forward to seeing you all for the next lecture 2.1.